It does completely depend, I think, on where you are, because really this recovery that we're hoping for is going to be driven by your own behavioral response. So if you're in a place where it's been ravaged by COVID-19, then you're less likely to feel optimistic about the future and can see this return to normal. Where if you're in parts of the countries which haven't been hit that badly, actually you're itching to go back to your normal life and you can see things going back to normal. And therefore your response in the way that you act about going out and going shopping, etc., will mean that you think that this market recovery has got legs. Now, the thing is that, I know when we look outside our windows at the moment, especially in places across the US, it seems incredible to even think that there could be a market rally when so much is going on in the background. But unfortunately, the thing is that with markets, they don't necessarily take notice of that. So what they're seeing is that there has been a number of positive news coming through in the last couple of weeks with regards to reopenings, with regards to fiscal stimulus, and also with regards to central bank stimulus.
It seems probably impossible to believe for many of our audience right now globally who have been glued to the TV screens watching these terrible scenes of unrest across the United States that people are going out to eat, people are buying homes, people are buying cars. We've got the CEO of Volvo coming up in a few minutes. Their worldwide sales numbers showing a rebound. We had a CEO of a home builder in the United States on Seema yesterday who said their May numbers were above those of May of last year when, by the way, we didn't have pandemics and we didn't have these kind of protests.
Right, and that kind of news is actually, I think, very astonishing. It's astonishing to me as well at this stage to think that there could be such a recovery in play. But again, I think it's being driven by a number of places which really haven't been hit that badly by the virus. Of course, if you're in New York or London, you feel that this is a very, very pressing matter. So you're unlikely to go out and buy new cars. You're unlikely to be wanting to go outside. We have surveys in the UK, and I'm sure in the US as well, in parts of the US, which suggests that 50% of households are unwilling to go back to their normal shopping habits unless it's just for groceries, because of their fear, not just around the virus and catching it, but also about their household finances, because we have to remember unemployment has shot up. A number of these jobs are simply not going to come back, and people have to be very cognizant of where they're spending their money. So when I look at this, I think, yes, Q3, we could see a rebound. And certainly when you're starting from such a low base, we should anticipate positive numbers for the third quarter of this year.
Yeah.
But when you get into Q4, that's when the concern is going to come through.
Seema, I love it. It was the most British thing ever. A pressing matter. I completely, I completely agree with you. We'll have viewers in New York who will tweet us, dude, the world is ending. Stocks are out of control, way overvalued. The Fed is in charge. Go home. Just get off TV forever. And then we'll have somebody in Tampa, Florida who will say, I'm out having drinks with my friends. Everything is fine. So with that in mind, Seema, when you look at those two wildly different perspectives on not just the markets, but also life, who's right?
Right, so I think it's somewhere in the middle, right? So we do think that there is a recovery in play. We just think it's a very, very slow recovery. And there's many, many risks out there. And certainly the protests, we have to consider that as well in terms of coronavirus spread as well. So I think the way that you have to invest your money is, one, you have to be invested, because think back to the global financial crisis. If you had missed out on that bottom level during the crisis, you would have missed out on 10 years of incredible gains. So you have to stay invested, but you have to be cautiously positioned. So we still like the high quality areas. We still like technology. And that's because there's a secular driving force there, which means that people are still going to be reliant on these technological forces. But again, you have to think about the cyclicals as well, because if there is a recovery in play, they will do better. But be discreet, think about which ones you're looking at, analyze them, and really active management almost comes into play at these kind of times.